This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us here today as we wrapped up another week of trade on Friday and we take a look at all the action. It was a wild week in the trade, to say the least. We are joined by our good friend Ted Seifried with Zaner Ag Hedge. Ted, good to catch up with you, buddy. Hope you're doing well.
Yeah, all is well, Jesse. Hope you're doing well, too.
Doing good here. I made the comment to you before we jumped on the air because I'm in full football mode. I mean, soybeans, cotton, crude oil were the superstars of the day. Wheat was just kind of chopping around, and then corn chopping around too, like the third string kicker on the bench. Just nothing going on in that corn market. But again, soybeans were kind of the star on Friday's trade, Ted.
Yeah, absolutely. Where do you want to start? Corn, to your point, has been in a very, very sideways tight range for about 2.5 months now. $6.75 to $7. That's where we're at. And apparently we found some value pricing. There are concerns that, well, maybe the price is too high. Are we seeing demand rationing? Because you look at the export sales, and we're pretty consistently looking at 10-year lows for those particular weeks. This week was one of those. 2 weeks ago was one of those. So we're not seeing sales, but there's a lot of time left in the corn marketing year. We'll see. We know Brazil had a much better corn crop, second season corn crop, Seifried corn crop last year than they did the year before. So they had more corn to go along further. So that's part of the reason. But also 10-year lows, Jesse, that, okay, that's more, there's more to it than that. So there has to be that concern out there to some degree, but there's still South American weather risk. If they have a problem and these sales come in and maybe we can still hit the USDA's projection, maybe it's too early to say, well, the demand rationing has taken place and now we need to see corn go sharply lower. That being said, the price action that corn's seeing in the last couple of days is maybe suggesting that it at least wants to venture towards the lower end of the range and test things out. Corn was able to close below its 50-day moving average on Thursday for the first time since August 19th. I know that because it's the day before my birthday. I was on a crop tour. Yeah, so the technical picture in corn seems to be looking like it's at least flirting with the idea of rolling over to the downside. However, you get all this strength in soybeans, which soybeans have a much different story. We're seeing a lot of export sales happening for soybeans. China has been active, even though this past week wasn't stellar. It was less than we were used to seeing in this week. We've come off some better weeks, Jesse, and it does seem like it's kind of coming around. So we want to give it the benefit of the doubt there. As you mentioned, there's been a lot of talk this week of China moving away from their COVID-0 policies. That talk, again, very much on Friday. And that was creating a whole lot of risk off. And anything that has exposure to China was finding quite a bit of strength there on Friday. Again, look at crude oil, for example. And not only that, going along with the risk on day on Friday, you had unemployment numbers. And you have a very strange sort of scenario happening with the broader picture of markets right now, Jesse, because the unemployment numbers, while the non-farm payroll numbers were higher than expected, which is a positive thing, the unemployment number itself went up from 3.5 to 3.7%, which is a bit of a negative thing. And even when you say, okay, well, we outperformed on jobs created, it's still lower than it was in September. And it was lower than it was in August. And so you have this sort of downward trend. And so I think what the market is feeling, and the reason why the dollar was sharply lower, and stocks at least started really rather strong, crude oil strong, risk on again, is because the market's feeling like one of the big drivers or that was allowing the Fed to raise interest rates as aggressively as they have been, 3/4 of a basis point in the last however many times, um, is because we've shown good jobs numbers, good unemployment numbers. And 3.7 is still a pretty good number, but they're
Mhm.
trending in the other direction. So I think the market is starting to feel like, okay, despite the very hawkish rhetoric that Powell was using on Thursday, there's a good chance that the Fed is going to have to at least slow down. It doesn't mean that they can't continue to go higher. And ultimately, the Fed has been saying, Powell in particular, is saying the high, the final destination might actually be higher than what we were thinking a month or two ago. So that is concerning longer term. But at least in the short to midterm, if we slow the pace of the rates increases and just go to like 1/4 or 0.5%, or maybe even pause, that can allow the economy time to digest it, and we're looking at that as being fairly bullish. You also have other countries that are now looking
Mhm.
at getting a lot more aggressive on fighting inflation and things like that, i.e., higher interest rates. So when you talk about the American dollar, it's an index against other currencies, so that comes into play as well. So lots of stuff going on, Jesse, and again, grain fundamentals, but also big macroeconomic fundamentals. And with all those things going on, you still have some very sideways ranges because you've got
Mhm.
a whole lot of things on both sides of the equation, and it's keeping us really on our toes. But also, and we have seen a lot of volatility. I mean, look at the wheat, uh,
Yep.
but it's been overall sideways, and we're waiting for this next big sense of direction, and to see which set of fundamentals win out. And I think for grains, ultimately, that's going to be South American weather.
Well, I was going to say South American weather and the grains, and then I wonder about next week's WASDE report. What could we see there? Could that be something to give us enough fundamental news to break us out of some of these ranges? We didn't bring up Russia Ukraine, but that gave us that premium to start the week, and I think that helped soybeans get above 14 and now hold there on some other things. But quarter wheat gave it all back. So I wonder next week's WASDE report on top of South American weather, could that be two things that give us this opportunity to break out one way or the other in grains, Ted?
Yeah. Okay. So there's two things we want to unpack there. Let's talk about the report, and then I'm going to go to the Russia-Ukraine situation. Um, as far as the report is concerned, you look at the trade guesses. We're looking for just slight adjustments. Really, nothing that particular, not that crazy, but a
Mhm.
little bit higher. It looks like for both corn and bean carryovers. Maybe trimming just a little bit of demand, which I do think the USDA would be justified in at this point, but really not looking for much in the way of production changes. And again, at the end of the day, we're not looking for much from this report. Is it possible that the USDA throws us a curveball? Hey, they've been known to do so. But historically speaking, the November and especially the December report,
Yeah.
a lot of times are just really nothing. They're placeholders. They're punts. To use your football analogy from earlier, they sit on the bench, right? Um, but something can happen. If USDA feels compelled to make changes, they will. Otherwise, we might be waiting until the January report to really get any direction coming from a balance sheet. But we'll have to see. Now, to your point earlier, South American weather, I think that really that's going to be the next big thing. But yeah, the Russia-Ukraine situation, that's, the on again, off again nature of that. I mean, Russia paused it, based on an attack on some of their ships in Crimea, and out of Sevastopol. And then we're back in the next day. So we put the premium in and then we took the premium out. But the fact that they were out really only for a day, um, really makes me feel like they can't really get out of that agreement. And we're talking about whether they're going to extend it or not. I think they're going to have to. Now they have some requirements of what they want. They want to have some better guarantees on how, or a better roadmap on how they can really resume their grain shipments, wheat, but also for fertilizer. And I would think that we should be able to give them some concessions for that, and allow those sorts of things, lift easing some sanctions maybe for very specific things. I mean, if we're talking about starving countries in Africa not having enough access to wheat, and that's why we have the grain corridor open in the first place, well then Russia, who is now actually going to give some of these countries wheat for free, should be able to do that too. That's just my opinion. I'm not a geopolitical analyst or war analyst, whatever. but that would make sense to me. And there's a big need for fertilizer, so I feel like we could use that too. And look, okay, since we're not directly involved in this war, I feel like some of these things can be done. That being said, the way that Russia acted this week, really capitulating to Turkey almost immediately, and then saying that, even if they were to pause again, they're still going to be sending grain. They're still going to allow Ukraine vessels to go to Turkey for Turkey. Well, they're all going to Turkey and then getting rerouted somewhere. How would that change, and how would they know the difference? So to me, just the way this week played out, the language used, I don't think Russia can get out of the grain corridor deal short of a major escalation in the war, i.e., us getting involved, a nuclear option, something like that. But if things from the war side of things kind of stay the way they are, I don't see that grain corridor going away again. And I think this week proved that.
Ted Seifried, Zaner Ag Hedge, is our guest today here on the show. Ted, thinking of a few other issues out there as well. Midterm elections are this coming Tuesday. Do you anticipate that, depending on what we see with the election, that it could have a major impact on the markets, on ag economy, et cetera? Do you think we'll see anything big there, Ted?
Well, that's a tough question, Jesse, because, depending on who you ask, there are some very different expectations for what's going to happen next week from a political standpoint. And I try to stay out of that.
Yeah.
Um, you know, but look, if there is this red tide that has been talked about, and I'm not so sure there are, because there's a lot of not great timing for the Republicans on some very key social issues. But if there's this red tide, you would think that the markets will really like that from a free market and less regulation. I mean, generally speaking, markets like it when we have more free markets. So again, stocks would like that. You would think that would do good things for commodities as well. However, the reason why we've been strong for the last couple of years is because of stimulus, which is a very democratic idea. So I really don't know. Look, anytime we get past some uncertainty, I think is a good thing for markets, generally
Yes.
a positive thing for markets. So I don't really see an outcome where elections are terribly bad for markets. I guess that's the best thing I can say about it. I don't know if there's going to be any reason for a sharp rally, though, either.
Mhm.
It'll be interesting to see what happens. I'm very curious myself, but I also don't know if it's going to have a massive impact on markets.
Sure. Well, I didn't mean to throw you down the political rabbit hole there, Ted, but just to kind of rope this all back in, and obviously we have so many issues impacting the markets, especially in grains right now. I didn't even touch on how dry it is across the country, but just thinking about farmers wrapping up harvest right now, grain farmers, let's think risk management wise here. They're getting a chance to slow down, take a look at their books, sharpen their pencil a little bit. Anything changing in your mind with some risk management strategy here as they look at things before we wrap up the year?
Yeah. So, this is a great question, Jesse. We've been in this tight, really 25-cent range in corn, right? And so that kind of lulls people into complacency. But the fact of the matter is, I mean, you look at this range between 770 or 675 and $7, really 680 and $7. You have to understand these are really very good prices, and especially if we've booked inputs at higher prices, we really need to protect this, right? Um, you can't just say, okay, since we've been sideways for the last 2.5 months, then we're just going to stay up here. This is where we're going to be. I think there's a lot more that can happen over the course of the next year that can push us into lower prices rather than higher. I mean, there's the reason why the market is sideways because there's opportunities for both. But I think the better likelihood or the higher odds are for down and could be sharply down, really, depending on what happens and what the cause is for that. But the tricky thing here is how do you express that, Jesse? What tools do you use, right? Because if you're using options, like if you had December puts, when markets go sideways like this, they lose a fair amount of value because the premium value, the volatility premium, the time value, all of that falls out, and the market's really gone nowhere. So it was, pointless, right? And that's the biggest thing that holds us back from doing something like that is we don't want to buy insurance if we don't have to. Um, okay. All that being said, is that the longer we go with a sideways market, the more likely it is we're going to have a bigger move, and probably sooner rather than later. The other thing it means is that option volatility and all the things that go into the pricing of options are all relatively cheap right now. So I think it's a really good time to go out and go into March or July and to go in and look for puts to get us into spring, into early summer. Um, because they're relatively cheap, and again, keep in mind the very high levels that we're trading at in these markets. I think it's paramount that you cover that downside risk. But when you do that, have in mind that, well, if we continue to go sideways for another 2.5 months, I highly doubt that, by the way, uh, I might be losing my option premium. You got to always prepare yourself for that, but again, I think right now is a great time to have some ownership in that low volatility premium and have some ownership of a worst case scenario to the downside.
Let's move over to livestock, Ted. Cattle and hogs just kind of chopped around, it felt like, on Friday to wrap up the week. But, looking at these markets, I know, demand, weekly exports on beef were just dismal this past week. Hogs were pretty solid. We look in what's going on in feedlot country and packer margins, et cetera. I know there's a lot swirl around this livestock sector too. What's your general thoughts in the protein trade as we get into the month of November?
Interesting thing about that. The hog charts and the cattle charts had not looked very similar over the course of the last 6 months, at least not in my opinion.
Yeah.
But in the last 3 or 4 weeks, there's very similar things that we've had. We had a pretty decent rally starting at the beginning of October as we got more, I guess, optimistic about the economy and the stock market coming back a bit and things like that. But then in the last 2 weeks, we've really pulled back off these highs and had a really solid correction. And for the most part, Jesse, I think that's just for a lack of really any major news. We've got both live cattle and hogs holding some very key support points at the moment from where we could try to bounce from. But there too, just like everything else, we've got a lot of news, especially on the bigger, broader macroeconomic side of things. We've got a lot of contradicting things. We have a lot of murkiness. We're very reluctant to take a very solid stance in really anything at the moment, it seems. So yeah, we had a technical correction. Both the live cattle and the hogs chart look like there could still be more upside potential. If we continue to hold the support that we had from Thursday and Friday, I think that's a pretty good possibility. Again, those charts still look good, and consumer demand seems solid, right? So as long as that's happening, I think that's good. To your point, yes, the beef exports. Hopefully, that was just a one-off week. But look at those pork exports. That was a really good number. What's a little bit disappointing about that, though, Jesse, is that last week when we saw 20,000 metric tons, that day we were down really rather sharply in hogs. But then on a day where we had 48,000 metric tons, if we're going to have bad export sales and sell off, well, then when we have good export sales, you really want to see a rally and you want to see it hold it. We really didn't do that. But it might just be saying that, hogs aren't just ready to make a move in either direction quite yet as we sit right on top of key support.
Well, Ted, great thoughts as always. Floor is yours. Before we run out of time, the famous open-ended question. Any final thoughts for us here today?
We covered a lot, Jesse. I'll go back to the idea that I think South American weather is ultimately going to be the major driving factor, which means we're going to have to wait a little bit longer. But look, Brazil's planting a monster crop, probably the largest crop the world has ever seen if all goes well. And they don't have to have a perfect growing season. If they have a normal growing season or even a little bit below normal, it's going to be very difficult to justify these higher prices over time. We're going to fix Brazil and Argentina, which are having concerns right now, but it's very early and things can change for the better or the worse. But there's just so much pressure. There's so much going on this South American growing season because if they have a decent crop, it really goes a long way to fixing the global tight stocks that we have. The adage that high prices are the cure for high prices in the form of demand destruction, which you can argue we're seeing in corn right now, but also in the form of supply increases, which you're going to see in the form of more acres in South America. Now, again, they have to grow the crop. So that's what we'll be hanging on. But if that crop's going to be there, to me, it becomes really difficult to justify the prices that we're at in corn and beans right now.
Well, Ted, fantastic stuff as always. And if folks want to talk to you and get a little advice there at Zaner Ag Hedge, what's the best way to get a hold of you, Ted?
Yeah, absolutely. You can reach me directly at 312-277-0113. You can find us on the web at www.zaner.com. We got a new Ag Hedge website. You can check that out. You can also sign up for our morning Ag Hedge newsletter. You can see our bios, things like that. And if you're on the Twitter, I am at the Ted Spread. I like to have a little fun on Twitter and also talk about markets from time to time too.
Well, he is a fun follow on Twitter, that's for sure. And we always enjoy catching up with him. Thanks for the time, buddy. Ted Seifried, Zaner Ag Hedge. We will talk to you again in a couple of weeks.
Yeah, thanks, Jesse. Have a good one.
And that's going to do it for today's episode of Market Talk. Find us online, markettalkag.com. I'm Jesse Allen. Have a great weekend.